Hello, welcome to Medidia. This is your host Tariq. So we will be talking about active stock picking, the topic you all wanted me to talk about. So let me start by saying there are multiple ways to skin a cat. Just like that, there are multiple ways to achieve financial success. I'm just sharing what worked for me in a limited time period, and hopefully you can all learn from them. So to begin with, invest only what you don't need in the next 3 to 4 years. Don't expect your money to grow overnight in a time span of less than 12 months. Also, for absolute beginners, I would suggest invest only what you're willing to lose so that you can learn from it in the beginning and never lose your money again. Also, one more thing before we jump to the active stock picking is I think in the long run, passive investing works better. Remember, in the long run, time in the market is better than timing the market. So, now, if you don't know what active stock picking is, what is passive investing, I suggest you to check out my video on that. I will try to put it somewhere on top. So, when should you consider active stock picking? I think it works very good in volatile markets, especially when I started into investing in 2019. COVID happened, I got lucky, and the market became really volatile. So that's what really helped me. Otherwise, in the long run, if the market is not volatile, I suggest sticking with the passive investing. Also, for the active stock picking, you need better emotional control, better emotional stability. So don't underestimate the value of that. Please, you need to control your emotions. It's a roller coaster ride with active stock picking, and you need to be very careful. So, what's the first step? The first step is to pick great companies. It's easier said than done, right? We all want to know which are the top companies we want to invest in. But what I would suggest is, if you're a beginner and you don't know what you're doing, start with FAANG. Those are some of the companies that everybody recommends, safe growing companies: Facebook, Apple, Amazon, Netflix, Google. So FAANG is a safe investment because these companies are way less likely to go bankrupt, and you're way less likely to lose your entire investment once you invest in FAANG. So the second is you get a paid subscription. You listen to somebody who has been doing this for a while, and you listen to them and their recommendations, and you buy their recommended stocks. What I recommend is Motley. I don't think there's any better paid subscription for active stock picking than Motley. So I very highly recommend them. The third option is you research the companies yourself. You read the balance sheets, you look at the quarterly reports, you listen to the investor telephone calls, conferences. If you're going to research and pick companies yourself, keep in mind that the fact are you going to lose your initial investment or not, that solely and entirely depends upon how much time and effort you put in to pick the companies. It really depends on what kind of companies you pick. So I think that is the biggest factor. Once you pick good companies, then you stick with them. So starting with what kind of companies you should be looking at, I think to begin with, if you're an absolute beginner, try to find value companies. Then the second step will be try to find dividend companies. The third one will be try to find growth companies. Once you have mastered the art of picking companies, good value and dividend companies, then you jump onto the growth companies. The issue with growth company is that the likelihood of you losing your initial investment is relatively high as compared to if you stick with value investment. Here, I will also talk about diversification. What does that mean? Never put all your eggs in one basket. So if you're going into active stock picking, what I do recommend everyone is pick 15 to 25 companies that you want to invest in. Okay, and never put more than 20% of your entire portfolio into one sector. Let's say energy or banking, finance, or software. Never put more than 20% in one sector, and never put more than 10% in one stock, one company, because what that does is your entire portfolio is then dependent on that one stock. If that tanks, your entire portfolio tanks. So what I do recommend everyone is pick at least 20 companies or 20 different stocks, broadly diversified between different sectors: finance, energy, software, and put 5% in each one of these companies at least. So let's say if you have a portfolio of 100,000 that you want to build, so at least you should have 20 companies and you should put $5,000 each in each one of these companies. Now, you have decided which companies to buy and you have decided how much you want to put in each one of them. Now, let's move on when to buy. So, let's say you want to put $5,000 in one company. What I would suggest is buy 10% of that 5,000 right now, irrespective of if the market is up or down. So $500, use that $500 that you want. Let's say if you want to buy Apple, put $500 in Apple today, and you want to build a position of $5,000 later. So once you do that, what do? You wait for the price to fall. When price falls, you check. First thing you do is you check, why is it falling? Is the company going bankrupt? Or if it is a benign thing, then in that case you go ahead and buy more. What I did was that if the price falls 3%, then I will buy an additional $1,000, or an additional 20%. If the price falls 6%, then you put an additional $1,500. If the price falls 10 to 15%, you buy $2,000. So that's how you slowly build your position. So again, I will say, if you want to put $5,000 in one company, you bought 10% initially, and then when it fell down, you bought 20%. It fell more, you bought 30%. When it keeps on falling, you keep on buying more. You get the idea. The more it falls, the more you buy. So but it's very important to see, why is the price falling. If, like I said, if the company is going bankrupt or there's something significant, you don't invest. If it's a benign thing, then always invest, and it's a good buying opportunity. What I did, I placed limit orders. I picked some very good companies and I placed limit orders using my brokerage account, and this entire process was then automated. I didn't have to monitor the market at all. Now let's move on and let's talk about panic selling, or fear of missing out. Never panic sell, never buy in FOMO. The worst time to buy a stock is when the price is skyrocketing. What I recommend is, any time that there is a stock that's going up and up and up, patiently wait for it to come down, and when it does come down, you buy it in bulk. And if it never comes down, not all the battles are worth fighting, right? You can buy another stock and win that battle. Going to panic selling, I think the worst time ever to sell a stock is when it abruptly falls down. If anything, that presents you an opportunity to buy excellent companies at cheap bargain prices. When everybody's panic selling, you check why it's happening. Is the company going bankrupt, or is it again some benign news? In that case, if it is a benign news, you go in and buy in heavy, because that stock is most likely never gonna go to sink further. And if it does, you buy more. So now, moving on to selling, when to sell. If you truly believe in a company, you never sell. If you stop believing in a company, if you think something changed and you don't think the company is going to keep on growing and it's not the good company anymore, that is the time you sell it. Or the other option is, let's say you find another good buying opportunity. You think this company is going to grow more in next few years as compared to the stock that you have been holding. Please note that I'm not pretending to be a financial guru, but a guide. I'm just sharing what I did and what worked for me. Hopefully you learned something, you found some value out of this video. If you did, please like it, subscribe to the channel, and share it with others. Like I always say, never give up, never lose hope, and work hard. Bye.